Digital assets and distributed ledger technologies will have an impact across multiple risk stripes for market participants, and in particular for Treasury and liquidity. There is a clear commercial opportunity derived by new capabilities in increased settlement speed and programmability that can meaningfully improve resource management and reduce buffers. Over the next 18 to 24 months, we are likely to see that opportunity become more compelling. Expect liquidity pools to get deeper, interoperability to improve, and product ranges to widen. This could be transformative in Treasury operations in the not too distant future, as firms' digital wallet integration matures, providing instant settlement to a variety of yield products. The DTCC published research in May this year estimating that tokenised collateral could halve intraday funding costs at major banks.
The opportunities around digital assets are clear, but they're not without their risks. Increased settlement speed and reduced buffers may mean that liquidity stress crystallises faster, reducing the time that you have to react. Also, redemption behaviours, smart contracts, and enhanced collateral mobility will bring new dynamics to stress. To manage those risks, while taking advantage of the opportunity digital assets offer, Treasury functions need to start preparing.
Two recent events exhibit some of these new dynamics. In March 2023, USDC depegged from the US dollar at 10 p.m. ET, outside of regular operating hours on a Friday evening. The stablecoin was worth at one point 12% less than the US dollar, after disclosing that a significant proportion of its backing assets were with the Silicon Valley Bank. And in 2022, when Terra, an algorithmic stablecoin, worth at the time $50 billion, collapsed in 3 days, a loss of confidence triggered mass withdrawals. Everything moved in real time, there was no breathing room, no overnight pause to bring a crisis management team together, and no settlement delay to assess and mobilise stress levels. This event played out at a speed that traditional crisis playbooks simply aren't designed for.
So, the approach to Treasury and liquidity needs attention. Most banks don't have reliable visibility of their intraday liquidity positions, which is key for digital assets. And Treasury will need to work closely with data and technology teams to achieve a mature capability. At the end of the day, the quality of your liquidity risk management is only as good as your underlying data. Alongside this, stress testing needs to consider new scenarios and be reviewed with a proper understanding of the digital asset ecosystem. And operating models will also need attention to make sure risk can be managed outside of traditional market hours. These exercises require coordinated efforts across a host of different areas, and the accountability doesn't just sit with Treasury and liquidity teams. In an increasingly instant and 24/7 world, data, technology, and operations teams must also be part of the approach to managing liquidity. And this isn't just our view. In March this year, the PRA published CP526, its most significant proposed reform to the UK bank liquidity framework in years, addressing the speed at which liquidity outflows can materialise. And last month, the Basel Committee confirmed targeted updates to its liquidity risk principles alongside its crypto asset review, with the two now moving in parallel.
Digital assets are changing market dynamics, bringing speed, continuous settlement, and automated workflows. This brings great opportunities to treasurers and liquidity teams. However, risk models must adapt.